What do you do when an asset is caught in a massive falling trend, flashing strong sell signals across the board? Yet, some people are quietly wondering if it's actually deeply undervalued.
Yeah, that is definitely the million-dollar question right now.
Right. So today we are taking a deep dive into the ProShares UltraPro Short QQQ.
The ticker for that is SQQQ.
Exactly. And just to set the stage, it is Wednesday, April 15th, 2026, and the ETF is currently trading at $62.11.
Which is a pretty staggering number when you look at where it came from.
Oh, absolutely. So our mission today is to look at the latest financials from our sources, decode the technical order flow, and figure out if this instrument is a brilliant contrarian play or just a incredibly dangerous trap.
And, there's a lot of conflicting data to sort through here.
There really is. But hey, real quick before we jump into the data, make sure you like the video and subscribe to our YouTube channel. And please leave your feedback in the comments. We want to hear your thoughts on this one.
We definitely read all of them.
We do. Okay, let's unpack this. If you pull up this chart on your brokerage app right now, what exactly are you looking at? Because, this isn't a normal stock, right?
No, not at all. If you buy shares of a normal company, you own a tiny piece of their business. But when you buy SQQQ, you are buying into a highly engineered financial tool.
Right.
It's a leveraged inverse ETF. Its stated goal is to deliver negative 3 times the daily performance of the Nasdaq 100.
Okay, so it's designed to do the exact opposite of the biggest tech companies in the world.
Exactly.
And to do it with leverage. So if the Nasdaq drops 1%, SQQQ should jump 3%.
Precisely. But the really critical word there is daily. It resets every single day. And to get that exact negative 3-to-1 ratio, they aren't just shorting normal tech stocks.
They're using derivatives, right?
Yeah. What's fascinating here is that the health of this entire fund relies on these complex swap agreements and futures contracts. They negotiate these directly with major institutions, specifically heavyweights like Goldman Sachs and JP Morgan.
Which explains why the financials look so strange compared to a regular stock. Like, looking at the data, the 52-week range is an absolute bloodbath.
Oh, yeah.
It's down from a high of $214.40, sitting near its low of 61.72.
Right.
And yet, the total assets under management, the AUM, is still hovering around $2.56 to $2.60 billion.
It's a massive pool of capital.
It really is. And it has an expense ratio of 0.95%, which is pretty steep. But then there's this massive dividend yield.
Right, the yield.
It's somewhere between 5.35 and 7.61%. When people see a huge dividend on a crashing stock, it usually looks like a screaming value play. But is that dividend just the interest generated from the cash they use as collateral for those swaps?
You hit the nail on the head. That trips up so many retail investors.
Yeah.
The yield is literally just the bank interest from their collateral.
Wow.
Because they hold massive amounts of short-term U.S. treasuries to back up these daily bets. That cash generates interest, which gets passed on as a dividend.
So you aren't getting paid because the asset is doing well. You're just collecting the exhaust from the engine, which really means holding SQQQ is like holding a melting ice cube in your hands.
That is a perfect way to describe it.
Because it's tied to those daily movements, it's mechanically designed to disappear over time due to decay.
Exactly. The structural friction, the fees and the daily rebalancing, it just melts the ice cube.
So now that we know we're dealing with a short-term derivative tool, let's talk about the absolute beating this ETF's price is currently taking.
Yeah, the chart is rough right now.
Just in the last 10 trading days, SQQQ has plummeted 30.64%.
It's a severe bearish trend.
And the indicators are screaming strong sell across almost all time frames. Immediate support is at that 52-week low of 61.72, and maybe a little zone around 63.8 to 64.67.
Right. And if it tries to go up, it hits heavy resistance at 69.1, 73.91, and a major ceiling all the way up at 89.42.
Plus, it's trading way below its 50-day moving average of 72.96 and the 200-day at 76.81. The momentum is highly negative, too. The MACD is sitting at like negative 1.71 to negative 1.8.
And the RSI is oversold to neutral, right around 27.16 to 38.77.
Yeah, so technically it's a disaster. But wait a minute. If every technical indicator is screaming sell and it's down 30% in 10 days, Why on earth is $1 billion of smart money flowing in?
That is the big anomaly.
Right. Over the last 12 months, the data shows $1.04 billion in institutional inflows versus only $329.57 million in outflows.
It's a huge discrepancy. But the thing is, institutions aren't using this the way retail traders do.
How so?
Well, a retail trader sees that money and thinks it's a directional bet. They think the smart money knows a crash is coming. But institutions are likely just using this as temporary insurance.
Oh, like professional hedging.
Exactly. If you have a massive, highly profitable portfolio of tech stocks, you don't want to sell them and trigger huge capital gains taxes just because you're worried about a short-term dip.
Right. That would be incredibly inefficient.
So instead, you buy a little bit of SQQQ. If the market drops, your tech stocks take a hit, but your SQQQ spikes and cushions the blow.
And if the market goes up?
Your tech stocks make billions, and your SQQQ loses money. But you don't care. It was just the cost of an insurance premium.
Okay, here's where it gets really interesting, though, because that institutional buying creates a psychological trap for the everyday retail trader.
It definitely does.
You see a ticker that used to be at $214, and now it's at $62. Human nature tells us, wow, that's deeply undervalued. It's a massive discount.
But if we connect this to the bigger picture, we have to look at the brutal math of leverage resets. It's not a discount. It's a value trap.
Let's actually walk through that math because I think people need to hear how this works.
Right.
Let's say the Nasdaq 100 is at exactly 100 points, and we buy SQQQ, which is also sitting at $100.
Okay, so day one, the market drops 10%. The Nasdaq goes from 100 down to 90.
Since my ETF does the opposite, times 3, it goes up 30%. My $100 investment is now worth $130.
Right. But on day two, the market rebounds. The Nasdaq goes from 90 back up to 100. To do that, the index has to gain 11.1%.
Okay, so the index is completely flat over 2 days. But because it gained 11.1% on day 2, my ETF has to drop 3 times that amount.
Exactly. 3 times 11.1 is a 33.3% drop.
So applying a 33.3% drop to my $130, that's roughly $43. So 130 minus 43 is, wait, I'm down to $87.
Yep.
I just lost 13% of my money, and the market went nowhere.
That is beta slippage. The daily compounding means losses compound much faster than gains, and that is why analyst ratings are currently sitting at generally a hold or strong sell.
Because in the mid to long term, the outlook is incredibly negative. I mean, SQQQ has lost 64.90% over the past year alone.
Yeah. Now, in the short term, because it's so extremely oversold on the RSI, there could be a temporary relief bounce if the Nasdaq suddenly pulls back.
Right. Which brings us to the actual catalyst. Let's look at the bull case versus the bear case for this ETF.
Okay, let's start with the bull case for SQQQ, meaning the price goes up. This entirely relies on a pullback in overextended tech stocks.
Like maybe a tactical hedge against unexpected geopolitical tensions?
That's one scenario. Or capitalizing on disappointing big tech earnings. The sources specifically mention companies like Netflix, Zoom, or Goldman Sachs.
If one of those giants issues terrible guidance, the tech sector panics and SQQQ spikes.
Exactly.
But then there's the bear case for SQQQ, which is what's happening right now.
Yeah.
Broad market momentum and a continued melt-up in large-cap tech.
The Fear and Greed Index currently favors greed for the Nasdaq 100.
Which keeps immense compounding pressure on inverse ETFs.
Mm.
So what does this all mean? How do you weigh this potential upside against the near certainty of long-term decay?
Well, the bull case requires the broader economy to stumble. And for retail traders, betting against the trend in a greed-favored market is just incredibly high risk.
Because of the high volatility, you're looking at rapid capital erosion if you try to direct invest rather than tactically hedge.
Exactly.
So, to summarize the outlook based on our sources today in the short term, extreme oversold conditions might yield a volatile relief bounce.
Right, a quick spike.
But the long-term perspective guarantees massive value decay. And of course, we need to remind you that this is strictly an analysis of the data provided. None of this is financial advice.
Absolutely. Do your own research. And,
Yeah.
this raises an important question based on the source material.
What's that?
The data offers a direct comparison between SQQQ and TQQQ, which is the positive 3 times leverage version.
Oh, right.
If you really want to see how this works, comparing their exact daily performance divergence over a year is fascinating.
It's the perfect way to see beta slippage in action on both sides. And I think that leaves us with a really provocative thought to close on.
Yeah.
When you look at the extreme decay of an ETF designed to bet against the market, what does that tell you about the relentless compounding nature of human innovation?
That's a great point.
The market naturally wants to push forward. Are you bold enough to bet against it, even for a single day?